Personal Finance Presentation. Create a personal budget overview. Prepare to get financially fit by practicing personal finance. The budget is our spending plan for future money management. In prior presentation, we looked at the personal financial statements, including the balance sheet and the income statement. Balance sheet showing us where we stand from a financial perspective as of a point in time. Bottom line being the net worth, assets minus liabilities. Income statement then looking back, usually a month or year, to see how we got to our prior point last month or year, the prior net worth, to the current point, showing that action in the form of inflows and outflows, in the form of income and expenses. We now want to use that information to make projections out into the future, usually focusing in on the action statement, therefore the income statement, to show us the activity that we plan on doing over the next time period, next month or year, so that we can then get to the end point, which would be our budgeted balance sheet, where we expect to be standing after the next month or year. So budgets can help us to live within our income. So obviously the point of the planning and processing would be to give us a path to help us with our income and spending, which can actually give us more leeway as we go through the process of spending, because we've done some of the thought process beforehand, meaning we can use less mental capacity to actually make the decisions during the month than we otherwise would. Spend money wisely. So clearly when we do spend the money, we want to do so in alignment with our ultimate goals and objectives. The planning process can help us with that. Reach financial goals. So we want to be setting short-term, intermediate-term, long-term goals, as we talked about in prior sections, and then think about being able to set the map of the plan and have our choices to be in alignment with the goals that we have set. Prepare financial emergencies. So we want to make sure that we have enough financial resources available in the event of the emergency. So we got to plan what are some types of emergencies that might be taking place. How much liquid assets generally do we want to have available that we can access in the event of an emergency, so that we can take action immediately and appropriately from the financial perspective at least. Develop wise financial management habits. So we want to be planning our budget that will help us to make plans and think about having habits that will be wise, hopefully, as we continue the process of budgeting and then seeing how well we did with our budgeting process, reviewing the budget. So the budgeting steps typically will be: step one, set your financial goals. So we want to think about what are going to be our goals. We talked about this in a prior section in terms of immediate goals, mid goals, which would be like 5 years and above, and then long-term goals, which might be over 5 years out. Obviously, the longer-term goals being things like retirement, things like our estate planning, and then the more immediate or mid-range goals might be to save up for some particular thing like a car or something like that. And we might have shorter-term saving goals for like saving up for a vacation or something like that we want to make sure that we work into our savings and budgeting plan. Estimate the income. So that now we're thinking about basically making a projected income statement. We're thinking about the income statement in the future. That's usually the statement that you're thinking of when you think about the budgeting, and we're usually more on a cash basis for this process. So we're looking at our income, thinking about what that will be in the next month or next year. Budget and emergency fund and savings. So we want to make sure that we take into consideration, as we consider our budgeting, any kind of emergency. Hopefully it's not something being on fire like this down below. But whatever emergency happens, we would like to have some available cash in order to deal with that, and we want to set up some appropriate amount for that. Step 4, budget fixed expenses. Step 5, budget variable expenses. Now, you don't have to break out your expenses between fixed and variable, but it might help you in order to do so for a couple different reasons. Note that these terms, fixed and variable, are generally found in managerial accounting for things where you have production of items. So, for example, a burger shop, if you do break-even type of analysis, would break things out between variable and fixed costs. It's very useful in that context. If you were, for example, to sell burgers, every burger that you sell, you could try to break down the costs that are variable versus fixed. The things that are variable are going to be things like the meat and the cheese, the buns, which you would expect to go up at a fixed rate for the most part with each burger that you sell and each burger that you produce. And then you can think about how many burgers you would need to sell in order to pay off the rent on, say, the cart. So the rent then, for example, is the classical fixed cost, and the types of things that change with the level of production is usually what we think of as variable costs. Now, in this context, it's a little bit different because, of course, we're not producing things and we're not having a complete focus on revenue generation, but we could break out these fixed and variable costs by behavior for similar types of reasons. In other words, normally we break out expenses by what they're used for, categories, rent, utilities, telephone, so on and so forth. But we might also want to think about them by behavior, meaning do they change with the level of, in the production place, production, in our case with the level of income, or not? And also, do we have control over them or not? So for example, fixed costs, the rent being the classic example, we don't have much control over the rent once we sign the lease on it. So our monthly rent is going to be basically the same. If you own the home, the mortgage will be the same way. You've already signed into it. There's no control over it in the short term. You might have some long-term control to change, say, the lease in a year or so. But in the year-long future or so, it is what it is. So it's also easy for you to estimate what's going to happen in the future because it's always going to be the same. You know what the rent is already. So it's easy to budget, and it's also something that you don't have any control over. And what you want to do is focus your time and energy on the places you do have control over when you're trying to tighten the budget or make adjustments or change behavior. And so the variable costs are where that would be then. The variable costs are the things that you may have some control over, and they include the things like spending on your personal expenses and entertainment and that kind of things, where you clearly have more flexibility to increase or decrease the budget. That type of spending also tends to go up as income goes up. It's not a direct relationship, but as income goes up, it goes up, and you can try to then proportion your increases in your budget to the revenue that you have and use ratios to basically allocate what your costs then will be, or help you to budget out into the future in that way. Now, also note that you're going to have some costs you're going to say, I'm not sure if this is fixed or variable. If you look at something like the utility bill, for example, the electric bill, you might say, hey, there's a baseline that I know I'm going to have to spend just to live averagely. And then there's some flexibility over that baseline that could vary quite a bit if I turn on the air conditioning a lot or turn on the heat a lot and so on. So you could think about that as a mixed cost and even try to break out between the fixed portion you don't have control over and the variable portion. But oftentimes, this is even a little bit more of a breakout than a lot of people do with a budget, to break it out between fixed being everything that you don't have much control over, and then the variable, all those things where you have at least some control over, and then you're going to have to go line by line on the variable cost to determine exactly how much control you have over it when you think about the projections into the future and your behavior changes. So number 6, review spending and saving, review the financial progress. So you want to review your progress then as you go through the budgeting process. And then step 7, revise goals and budget allocations. So then, of course, you make the revisions that would be necessary for the next round. So here's going to be a quick budget. We'll take a look at this in more detail in the future, but you can see it in essence looks like the income statement. What we have here is in essence an income statement type of form, but we're projecting out into the future now, into what's going to happen in the future as opposed to what's happened in the past. So the income statement reports what has already happened. It should be as accurate a reflection as we can get to the data that has actually happened. And the budget is obviously our projection of what we expect to happen or plan to happen into the future. Now we've put it in one column instead of breaking out multiple columns so that we can do comparisons on a side-by-side basis. We've got the income up top and the expenses broken out between the fixed expenses, variable expenses. Clearly, the expenses are the things that will vary a lot from the business to the personal, because the expenses are something that you need to decide on what's best for you, depending on what you're kind of focusing in on for your personal budget. Then we might do a percent of sales allocation. These percentages can help us to determine what we're going to budget out into the future, especially as the wages possibly change. Meaning, if I have a change in income, what's going to happen to the changes in my costs? We can try to say the variable costs are going to change relative to income and use those percentages to help us allocate out into the future. We'll take a look at more of that in our practice problems in more detail. Then as time passes, we'll have actual data, and we can compare the actual data to what we plan to happen, the budget versus actual type of report. We can look at the variance or the difference column to see that difference, and then as time passes, we can allocate and adjust what our budget's going to be for the next period.